Two driveways, same cul-de-sac. In the first, a leased BMW X5, washed Saturdays. In the second, a 2018 Camry with a dent nobody's ever fixed. Brandon, the BMW, is worth $210,000. Diane, the Camry, is worth $1.4 million. Brandon's 42, a dermatologist, clearing $280,000 a year. And every third Sunday, he's up at 11 at night, moving money between accounts so tuition clears. Diane's 58, owns a heating and air company, makes $95,000, and last month wrote a check for her nephew's tuition without opening an app. 3 streets over, Ray, 46, warehouse supervisor, $72,000 a year, is $900 a month into a Silverado that's never towed anything. This isn't a story about being cheap. It's about what your stuff tells people and what it costs. My name is Nick, and today we're taking apart the most expensive lie in American life, that looking rich and being rich are the same thing. They're not. Often they're opposites, and the math is brutal. Start with the number that reframes everything else. The late Thomas Stanley spent decades surveying actual American millionaires and found the typical one spends around 1% of their net worth on the car they drive. The typical American buyer spends about 30%. Same object, same parking lot, 30 times the relative bite. But the funny part is the brands. When Stanley published The Millionaire Next Door in 1996, the most common car among millionaires was a Ford. When his daughter Sarah Stanley Fallaw redid the study in 2018, surveying 600 millionaires with a median net worth of $3.5 million, the top brand had become Toyota. Then Honda. So the badge of American wealth is functionally the absence of a badge. I want to kill a myth here, because this book gets misquoted constantly. It is not true that millionaires only buy used. Stanley wrote that for every millionaire who prefers used, two buy new, and the average decamillionaire spent about $41,000 on his most recent car. That's real money. It's just a rounding error against 10 million, which is the point. They buy quality, keep it a decade, and refuse to let the car be a percentage of their identity instead of a percentage of their assets. And Stanley gave us a formula for checking which side of that line you're on, which I'm about to use on you. Take your age, multiply by your pre-tax household income, divide by 10. Subtract anything you inherited. That's roughly what your net worth should be. Double it, and he calls you a prodigious accumulator of wealth. Land at half or less, and you're an underaccumulator. Run Brandon. 42 times 280,000 divided by 10 gives about 1.18 million. He's at 210,000. That's 18% of target, and most of it is equity in a house he can't sell without buying another house. Now Diane. 58 times 95,000 over 10 is 550,000. She's at 1.4 million, 2.5 times target, earning a third of what he earns. And at the block party, everyone assumes he's the rich one, including him. There's a reason you couldn't see that coming, and it isn't modesty, it's arithmetic, and I'll show you exactly how it works at the end. The formula has flaws, and I'll name them. It punishes the young, since a 26-year-old making $140,000 is guaranteed to look like a failure on paper. It flatters the old. And the sample is people who already made it, so it can't separate frugality from luck. Treat it as a thermometer, not a verdict. But the direction it points is correct, and the car market is where you watch it happen live. Experian puts the average new car payment at $770 a month on a loan just under $44,000 stretched across 69 months. Almost 6 years. Nearly 19% of new loans now carry a payment over $1,000, up from about 5% 5 years ago. Here's the twist. Roughly 74% of those $1,000 payments are not on luxury vehicles. It's the F-150, the Silverado, the Ram. Which brings us back to Ray. His Silverado can tow 13,000 pounds. The heaviest thing it has ever carried is a Christmas tree, and that was strapped to the roof because he didn't want to scratch the bed liner. The looking rich tax in this country isn't being paid in the exotic car lane, it's being paid in the school pickup line. Then there's the number I can't stop thinking about. Edmunds found 31% of trade-ins this year were underwater. owing more than the car was worth by an average of $7,183, a record. So nearly 1 in 3 people trading in a car is trading in negative net worth. The thing in the driveway that reads as success to every neighbor is arithmetically a hole with a warranty. And most don't pay it off, they roll it. Those buyers finance about $56,000, $12,000 more than typical, and pay around $15,600 in interest instead of $9,600. 43% of those loans run 84 months. You'll be paying for that truck longer than most people stay at a job. Underneath all of it is depreciation, the quietest wealth destroyer in the country. iSeeCars found the average new car loses about 45% of its value in 5 years, but a BMW 7 Series loses 67%, roughly $65,000. Break that down, because the annual number hides what's happening. $65,000 over 5 years is about $36 a day, every day, including the days it sits in the garage, including the day you're on vacation and it hasn't moved. You are feeding a parking meter that charges you $36 to not go anywhere. A Jaguar 1 Pace loses 72%. A Maserati Quattroporte was the worst on the list, shedding north of $70,000, a paid-off house in some counties, evaporating out of a parking space silently, while the owner feels great every time they walk up to it. Now, Diane's Camry lost about half its value too. It just did it between 2018 and 2022 on the previous owner's dime before she ever saw it. She bought it after the expensive part of its life was over. That's not frugality as a personality trait. That's just letting somebody else pay the meter. So keep this sentence: the more expensive the signal, the faster it decays. You're not just spending more to look wealthy, you're spending more to lose money faster. Which brings me to the statistic that made this click, and it isn't about cars at all. Research from Pimmons and Lending Club found 62% of Americans live paycheck to paycheck. Grim, not surprising. The breakdown is the surprise. 48% of people earning over $100,000 say it, and 36% of people earning more than $200,000 say it too. More than a third of $250,000 households are running on fumes. I'll be honest about that number so you trust the rest. That survey defines paycheck to paycheck loosely. So stricter ones like Bankrate land closer to a third overall. Fine, even the conservative version says the same thing. A big income doesn't produce wealth. It produces the option to produce wealth, and most people trade that option immediately for something with heated seats. So let's price the trade. The gap between the average new car payment of $770 and a solid 3-year-old used car at $300 is $470 a month, roughly one dinner out a week. Invest that at 7%. After 10 years, about $81,000. After 20, $245,000. After 30, somewhere around $570,000. That's one decision made repeatedly by the same person on the same income. Now look back at the two driveways. Diane didn't inherit anything and didn't pick a magic stock. She earned a third of what Brandon earns and refused to convert her raises into visible objects. Her net worth is, quite literally, his car payments pointed the other way. That's the whole mechanism. Consumption and compounding are the same dollars facing opposite directions. Every month you choose which way they point, and the arrow is invisible to everyone except your future self. Houses work the same, just slower and with more paperwork. Maintenance alone runs 1 to 2% of a home's value every year before taxes, insurance, and utilities that scale with square footage. So a $900,000 house is that number, plus about $1,000 a month, forever for the privilege of things breaking. And houses recruit. Bigger rooms need furniture that fits them. Nicer neighborhoods have a driveway standard. The renovated kitchen makes the old dishes look sad. Economists borrowed a name for this from a French philosopher who bought one beautiful dressing gown, decided everything else he owned looked shabby beside it, replaced all of it, and went into debt over a bathrobe. For scale, the average American home in the 50s was under 1,000 square feet, holding 3.5 people. Today, it's more than double, holding fewer than 3. We buy steadily larger houses to store steadily fewer humans, then pay 1 to 2% a year to heat the difference. Okay, so that's the money. Now here's why we do it anyway, which turns out to be the older and more interesting question. Somebody named this in 1899. Thorstein Veblen coined the phrase conspicuous consumption, and his argument was blunt: in a society organized around money, status doesn't come from having resources. It comes from visibly wasting them. The reputational value lies in the waste itself. If it were merely useful, it wouldn't prove anything. It has to be a little stupid to work. That's not a moral failing, it's a signaling system, the same reason a peacock drags around a tail that makes it easier to eat. Robert Frank updated it in Luxury Fever with the mechanism that spreads it: expenditure cascades. When people at the very top spend more, they move the reference point for the tier below, who adjust, which moves the tier below that, all the way down until Ray is standing at his cousin's wedding feeling quietly embarrassed about an 8-year-old sedan that starts every morning. Nobody in that chain made an unreasonable decision. They responded rationally to a frame shoved downward by people they've never met. Which is why I don't think Ray is an idiot. He's a downstream casualty of a status economy that spends billions a year keeping the frame moving. But here's the joke at the center of all of it. In 2000, the psychologist Thomas Gilovich made college students wear an embarrassing t-shirt into a room of peers, then asked how many noticed. They guessed about 50%. The real number was 23. For ordinary shirts, the gap was worse. They guessed nearly half. Actual recognition was under 10%. He called it the spotlight effect. You are dramatically overestimating how much anyone is looking at you. Run that against the car payment. You're paying $770 a month for 69 months to impress an audience paying half the attention you think, most of whom are too busy worrying about their own truck to have an opinion on yours. If that landed a little hard, good, because that's the part I want you to sit with, and it's why I built a school community. It's a room where people run these numbers honestly, without anyone performing a lifestyle at anybody. Spreadsheets, real monthly math, and nobody judging your dented Camry. Links in the description, and it's the actual antidote to the problem this video describes. Now, the modern version of this got sneaky. Around 2023, the culture decided loud logos were tacky and invented quiet luxury. Stealth wealth. And what happened next is possibly the purest thing capitalism has ever done. Quiet luxury, a philosophy explicitly built around not signaling wealth, instantly became a product category with a uniform. Loro Piana. The Row. Cashmere sweaters at $1,000 to $3,000. A baseball cap for $450. The whole proposition is that it has no logo, so only the right people recognize it. So picture two men at a party in identical, unbranded gray sweaters silently clocking each other from across the room. Each privately certain the other one gets it. That's a secret handshake that costs 30 grand and only works on people who already have 30 grand. Meanwhile, the financing layer got better at hiding. LendingTree found 47% of buy now, pay later users admitted a late payment last year, and about 60% say they've used it for something they otherwise couldn't afford. That's the whole game. It doesn't sell you a $200 item, it sells you the appearance of someone who can casually absorb a $200 item. And nearly a quarter of new vehicles are leased now, averaging $612 a month, meaning a lot of the luxury cars you see aren't owned by anybody. They're rented. A monthly subscription to an impression. And the cost is measurable. Intuit Credit Karma found 29% of Americans report money dysmorphia, a distorted read on their own finances. Among Gen Z, it's 43%. Here's the detail: 37% of them had more than $10,000 saved. They weren't behind, they just spend hours a day inside a feed engineered to make them feel behind, and none of this gets fixed by more money, which is where it stops being about taste. You've heard that 78% of NFL players go broke within 2 years of retiring. That stat isn't real, and I won't use it. The actual research is worse. Economists, including Anna Maria Lusardi and Colin Kammerer, pulled real bankruptcy court records and found 15.7% of NFL players filed within 12 years of retiring, on median career earnings of about $3.2 million. And the finding that matters, the rate was essentially unrelated to how much a player earned or how long he played. More money for longer protected nobody. Because the problem was never the size of the income. It was that the lifestyle got built to match the best year and never came back down. Lottery winners do the same thing. A study of Florida winners found large prizes made people less likely to file bankruptcy immediately and more likely to file 3 to 5 years later. The windfall didn't prevent the collapse. It scheduled it. Alright, before I tell you what to do, I have to argue against myself, or this becomes the same smug frugality lecture you've heard 400 times. Because appearance genuinely pays, and Ray is the proof. Hammermesh and Biddle found a 5 to 10% earnings penalty for being rated below average in appearance, at least as strong for men as women. Ray manages people, negotiates with vendors, and gets looked at by a regional director twice a year. On $72,000. That swing is somewhere between $3,000 and $7,000 a year. It's not vanity, it's income. But look at what those findings actually reward. Looking presentable, healthy, put together, that's cheap. A tailored $40 shirt beats an untailored $400 one in every study I've read. Nobody has ever measured a wage premium for a badge on a hood. Ray's promotion was never inside that Silverado. And second, bigger, for a lot of people, the problem isn't the truck, it's the income. Household wealth over the last decade moved mostly on asset prices, housing, and equities, which rewards people who already owned things. Add stagnant wages against inflated assets, healthcare, and student debt, and you get a gap no amount of skipped coffee closes. Anyone telling you the middle class could discipline its way back is selling something. So let me be precise. Looking poor is a lever. It's the strongest one available to a high earner who is the person most likely to waste an enormous income on nothing. It is not a replacement for an income. If you're choosing between groceries and gas, this video isn't about you, and you were never the problem. The version that works looks incredibly boring. Warren Buffett bought a 5-bedroom house in Omaha in 1958 for $31,500. He still lives in it. It's worth around $1.4 million now. In a shareholder letter, he ranked it his third best investment behind, and I want to be clear that he means this, 2 wedding rings. Then added he'd have made far more money renting and putting the purchase price into stocks instead. So the greatest investor alive rates his own house below jewelry and calls it a mistake anyway. That's the mindset, not deprivation. Accounting, or Chuck Feeney, who built the duty-free empire, gave away roughly $8 billion anonymously, wore a Casio, flew economy, and for his last 30 years owned neither a house nor a car. He died in 2023 with about $2 million to his name, exactly as planned. Nobody passing either man in a grocery store would have guessed. So, last thing, what does this mean on a Tuesday? The most useful number in personal finance isn't your income, it's your savings rate, because it does 2 jobs at once. It raises how fast you accumulate, and it lowers the total you need since the target is a multiple of what you spend. Save 10% of your take-home, and you're looking at roughly 5 decades of work. Take it to 20%, and you're at about 37 years. That second number isn't 10% better, it cuts more than a decade off your working life. And it comes out of one raise you didn't spend. I'll flag that this assumes a 4% withdrawal rate. Plenty of serious people call too aggressive over 40 years, so use 3.5 if you want to sleep better. And for most middle and upper middle income households, that jump isn't made by earning more. It's made by not converting the last raise into a payment. That's the whole strategy. Buy a 3-year-old car and drive it 10 years. Buy at 2 times income instead of 4. When a raise lands, let your savings rate absorb it before your lifestyle finds out it happened. Do that for 2 decades and you become the boring person on the street with a dented Camry and a 7-figure brokerage account, which is a wildly underrated way to live. Because here's what I think happened to Brandon. Nobody handed him a bad decision. He got a series of reasonable ones, each sensible on the day he made it, each moving a reference point slightly, until at 42 he owned an impressive life he couldn't stop paying for. He isn't reckless, he's just visible. Ray's still got time. His truck has 11,000 pounds of unused towing capacity and about 4 years left on the note, and the day he trades it for something that starts every morning and impresses nobody, he buys back roughly $600 a month for the rest of his life. And Diane is going to retire 11 years before both of them, in a paid-off house, driving a car nobody notices, while the whole street assumes she got lucky. So here's the arithmetic I promised you. Wealth is what you don't see, and that's not a metaphor, it's a definition. Your net worth is made entirely of the things you didn't convert into objects, which makes it permanently invisible, which means anybody who looks wealthy is showing you the exact portion they gave up. So the question was never whether you can afford it. Financing will always say yes. The question is the one nobody asks in the showroom: who am I buying this for, and are they actually looking? Per the research, they're not. They're at home at 11 at night, moving money between 2 accounts, hoping nobody notices. If you want help running your own numbers, come find us at our school community. Bring the ugly ones, we like those better.